Hi everyone, I'm Ron Corning. Welcome to Horse Sense Street Smart Investing. I have the honor today of opening the podcast and introducing both Clark Hodges and our special guest, Alan Ebright, the Director of Client Relationships. Hey guys, good to see you.
Good to see you. You're a lot better at that than me.
Oh, come on. You're getting there though, Clark, right? We take baby steps here. Now, don't ask me any questions about how to manage money because I can't do that. You see how we're a balancing act here.
There you go.
All right, Alan, good to have you here. Thank you for being here. And I love that you're here because we really want to break down for people in terms they understand the nuanced differences, maybe nuanced, maybe in some cases not so nuanced, between financial advisor and a registered investment advisor, which Clark and Craig both are that, and there are other officers here. What is the main difference?
Well, first off, great to be here. Thanks for having me. I kind of like to tell people that when you're out looking for financial advice, most of the time people think it's a very level playing field, that if you go meet with financial advisor A, he or she's going to tell you the exact same thing as financial advisor B. And sadly, it's just not the case. So you as a prospective client of an advisor have to be asking the right questions. Mm-hmm. There are some advisors out there that make a living by selling insurance products, annuities, or life insurance, and they can call themselves financial advisors. The typical advisors that work for brokerage firms or banks, they call themselves financial advisors. And a lot of their compensation might come from selling financial products to gain some sort of a commission. There's absolutely nothing wrong with that. But when you're selling a product to get a commission, it does invite in potential conflicts of interest between the client-advisor relationship. Mm-hmm. And what I found is the individual investor with every growing year becomes more aware of the landscape. There's more information out there. They educate themselves. And my number one thing for people is start with a registered investment advisor. And that means that entity, Hodges, is a registered investment advisory. And when you have that multi-decade client-advisor relationship, it's going to move along swimmingly. There's no hidden agenda. There's no ulterior motives, but to just give you the unbiased financial advice.
It is interesting, Clark. We talked about age in the last podcast and about at what age do you begin to seek help. Are you seeing now in this environment with more young people having more access to trading stock as day traders on Robinhood, and it's more the topic on social media platforms and et cetera, that younger people are more interested than they used to be in how they invest and save their money? And are they seeking financial help, or are they seeking your help sooner than maybe they were 10 or 20 years ago?
Well, it's definitely more of a popular topic. I would say that the younger Robinhood type crowd, if they're day trading, if they're getting in, getting out, they're really gambling. And they will learn that over time, which will make them really good investors in the long run. Let's say a 25-year-old person is doing it now. Then when they're 35, they're going to have taken some lumps along the way and figured out, hey, this is probably something I should change the way I look at it. It's not gambling, it's investing, mm-hmm. which means you buy and you hold. You don't try to trade in and out of stocks. Mm-hmm. But by and large, when the market came back so much from the low after the pandemic started, it's shocking to me, but it's definitely a topic, again, that wherever you are, people are talking about it. So there's definitely more and more people into looking at the market, talking about the market. It's just a matter of, do they hire somebody to do it for them, or do they want to do it themselves?
I think your dad had so many amazing quotes, many of which he came up with himself and shared and gave that advice out. Others that he's collected in his book from other people that just inspired him. I love this one about risk. I'm going to tee you up to deliver that quote from your dad.
Yeah, my dad would always say, you don't need to avoid risk. You need to assess the risk, because there's risks in life. Driving home today without a seatbelt, that's a risk, right? So you need to assess the risk. So a research analyst's job at our firm would be to find in the company that he's looking at, what are the risks to this company going forward? And are they too much to take? Is the risk too much for us to take? Or is it something that you can assess and say, That's not a bad risk. That's just a normal day-to-day type risk, if you will. So it is something you have to have risk in an investment to make money at it, right? So it is something that Dad would always say is you have to assess that risk, not avoid it, not run from it.
Well, it's interesting, and again, this is not to say anything disparaging about those who work for larger firms and are financial advisors, but conventional wisdom has been that has trickled down to those of us who are sort of lay people trying to invest our money, that the older you get, the more conservative you have to get in how you invest your money. And what you're basically saying, I think, Clark, and what your dad believed and what you now believe with your private client product is essentially you don't have to necessarily be risk averse the older you get. You just have to be better at risk assessing. And that's what you folks are here for. Your dad used to invest in risky mutual, what would be categorized as risky at 80?
At 80, right. His own fund that he managed, he was putting money every single month into that fund. He died at almost 81 years old, but that was still going into the fund at 80 years old. He obviously knew what he was investing in. He believed that common stocks was the best way to have capital appreciation, to beat inflation, and he was basically investing his money for the next generation. And so he was okay with the level of risk that gave him because he was fine with his money. He wanted to invest that for the family, for the next generation.
So, Alan, a registered investment advisor will give you the benefit of choosing individual stocks based on any number of factors at any particular time. So, for example, the concerns about inflation that many are talking about, there are companies out there that may be inflation proof, and those companies could be part of a portfolio of stocks that an RIA or registered investment advisor could pick. Is that a good example?
Well, a little bit. Let me give you a little more kind of context here. So there are other advisors out there that might use individual stocks. Being a registered investment advisor is just a legal setup for how you run your practice with the relationships you have with your clients. I think what we bring to the table is having a group of dedicated analysts inside of your organization that spend 8